Right, it's just gone 9 and I know we've got a lot of content to cover, so we'll get going and I'm sure other people will join us and catch up as we go along. So welcome everyone, welcome to BDO's webinar focused on professional services firms. For those who don't already know me, my name is Anna Gerald. I'm the tax partner leading our professional services tax team here in the UK. For those who already don't know, BDO is a global accounting network with over $10 billion in revenues, providing auditing, accounting, taxation and consulting services in 167 countries and way over 90,000 people now, and these stats are a bit out of date. So our session today is about US taxation, and we'll be touching upon UK basis period reform and impact on the UK entities doing business in the US. Just to run through our speakers and to introduce them, our speakers are both drawn from both the US team in BDO and the UK team of BDO. We've got Megan Ramonio, Louis Keeping and Ashley Graham, all coming with different areas of expertise and having a good discussion about the US tax position as it currently stands. So just to pick up on Megan first of all. So Megan is a director in the US business tax team, currently based in the UK, specially advising on private equity-backed companies along with private equity funds. So Megan advises on US tax impact of acquisitions, reorganisations and restructuring with a particular focus on partnership structures and investors. And along with working with BDO in the UK, Megan is also part of the national tax speciality team within the BDO US team, applying complex partnership rules for national BDO clients. And that international aspect is really key to our professional services firms clients. And Louis is an associate director in the professional services team. And many of you would have heard Louis speak on these webinars in the past if you've joined. And just on that, actually, you can see our backstory if you go to our website or also on YouTube. And you would have seen, if you've heard him speak before, that Louis got a portfolio of UK and international based professional services clients with extensive experience undertaking advisory and structuring work, as well as partnership and partner tax compliance and tax reserving matters. So really that all-rounded tax advisor, knowing all of those sort of broader issues, as well as the compliance and how to tell the revenue about what's going on. So Ashley is a dual qualified individual, both on US and UK tax, is an associate director at BDO. And Ashley has experience of advising US people that are operating businesses in the UK with a focus on US international tax matters as they affect partnerships, controlled foreign corporations and passive foreign investment companies. Ashley also advises individuals and businesses that are looking to expand into the US market. Both angles are really particularly pertinent for professional services firms. So we're going to be covering a range of topical subjects today. So we're going to go through an overview of Biden's electoral campaign commitments, the recent US tax developments, the UK basis period reform and impact on the UK-US businesses, and then picking up questions at the end. Please do ask those questions during the webinar using the Q&A feature, which is at the top of your screen. We'll pick up on as many questions as we can at the end of the webinar. And if we don't have time, we'll pick up with you directly after the session. So we'll be recording the webinar as we always do, and we'll email you with a slide deck as well as a link to the recording in a few days, and we will finish within the hour. I'll now hand over to Ashley. Over to you.
Hi, good morning, everyone. So we're kind of going to start off with an overview of what we discussed last year. So we did the webinar, we did an update in December last year, and that was all around what Biden and Trump had put into their electoral campaigns. So basically, we'll pick up from there to set the scene, and then we'll try and go through what the changes have been. So as a brief overview of what the current law is and the tax proposals President Biden wanted to bring into law during his presidency, the main thing was around increasing tax revenue due to the pandemic and also reducing some beneficial deductions. His main proposals included increasing the income tax rate from what was a 37% rate to 39.6%. They wanted to reduce the benefit of a long-term capital gains rate, which is currently at 20%. They want to increase that for higher earners up to the income tax rate of 39.6. So effectively limiting the preferential long-term capital gains rate for high income earners. We want to increase the corporation tax rate from current 21% to 28%, with a minimum tax of 15%, which feeds into the OECD discussions around a global minimum tax. And then they also wanted to increase the tax on controlled foreign corporations. So there was huge changes with that when Trump became president 4 years ago, and that was around taxing controlled foreign corporations in the income they earn, but there was some beneficial deductions which reduced the effective tax rate down to 10.5%, with the ability to use taxes paid in that foreign jurisdiction to potentially reduce that down to zero. What Biden wanted to do is to get rid of that, get rid of the beneficial deductions, and he wants to have a minimum tax on CFC income at 21% or at the corporate tax rate that is agreed. So this kind of sets a scene for where we were last year and what was thought about by Biden during his election campaign. The next few slides will talk about what has happened, what hasn't happened, what is currently being discussed, because at the moment nothing has been signed. We are at, I think, maybe a fourth or fifth proposal that's been put through the Senate. So we'll go through some of them things. If you can go to the next slide, please.
Yes, actually, everything's up in the air basically at the moment. So we've got the current position, we've got some thoughts, but that's changing on a regular basis. So what you're going to set out is sort of where do we currently stand, and what might happen.
Yes, exactly. So we'll intend to talk through the SALT deduction cap, which we've seen a lot of debate on, and it's been a very hot topic. We'll also run through some minor changes around the infrastructure package, which has been signed into law. There was only a couple of tax updates on that. And then more interestingly, we'll go through what is currently going through Congress called the Build Back Better Act, which is going to have quite a lot of tax reform changes in there.
Okay, and actually I have seen a lot of clients asking about the state deduction cap. It's sort of a different concept to how taxes operate here in the UK. So how is this playing out in the US?
Yeah, so the state deduction cap is interesting. So you've got a federal level of taxation and a state level of taxation where the states control how they're going to tax businesses and individuals. It all kind of started, and the history was that you could basically deduct your state taxes against your federal income, so you could get an effective deduction. Yeah. It all started when President Trump kind of introduced a cap to that, and he said, no longer can you deduct everything that you pay to the states against your federal income. You have a maximum that you can deduct of 10,000 now, which basically changed the well-established procedures that have been there for many years. It was obviously a major blow to states like New York and California, who are high income taxing states, and people resident in those states, where you've had them thinking, do I really need to live in New York and California and pay state tax on all of my income? Or could I live out of state, possibly commuting to work, or with the pandemic, I'm working from home, so I'm not effectively working in them states. Is there a position that we can take that I don't actually work or live in them states, so I don't have to pay them state taxes, which all would really have an impact on the state's revenue and how it could operate. There's basically been a lot of jostling and arguing between the states and the federal government for the past 4 years, where effectively the states have been trying to create workarounds. So Megan's going to take us through what's happened over the last 4 years and some of them workarounds. So if we go to the next slide, Megan can take us through that.
Thanks, Ash. As Ash outlined, the TCJA in 2017 put a federal cap on deduction for state and local taxes to $10,000. So of course, the high taxing states like California and New York then had all of their residents have a higher effective tax rate because of this loss of deduction. So there was several actions that have gone through. The first action by the states was to try to work around that essentially recharacterize the state and local payments as a charitable donation, allowing a federal deduction. This was closed down by the IRS by releasing regulations, so that completely prohibited this type of planning. Then the IRS, again, kind of incensed by the pandemic and people moving and changing states, issued a notice that did provide the states an opportunity for a workaround. What the notice did was provide pass-through entities, such as partnerships and S corporations, a federal tax deduction for state and local payments that are imposed against the pass-through entity's taxable income, thereby having the pass-through itself pay taxes and make the deduction rather than putting the tax payment out to the members, which is historically what has been done. So states very quickly jumped on this and started to enact rules allowing a pass-through entity to elect to pay the state and local at the entity level in order to achieve the effective deduction. Currently, there are around 20 states that have enacted their own pass-through entity tax election rules.
It's fascinating, all of this, in terms of how the pandemic is changing, how states are needing to, and federal governments are needing to set their own tax rolls. So does this really mean that we're back to the pre-Trump, tax reform position of states' tax deductions, or not?
Not quite.
Right.
So currently, as it stands, what's happening, and the biggest issue with this potential workaround, and we'll call out California. So in California, they do allow you to make this election, thereby the company makes the payment and they get this deduction. However, they're still required to withhold taxes for their non-resident members. So they're paying the full tax in the company, and they still have to pay for the non-resident members. They still have to withhold unless they make an election. With that, there is an issue in California that has a minimum tax. And this credit for this tax payment for the states isn't necessarily against this minimum tax. And so there is a potential that you're going to wind up paying more state tax because of this. Additionally, right now, there is still that limitation outside. And so there's other states that haven't elected this. And they are looking at increasing the cap, but they're increasing it from 10,000 to 80,000. So currently, there's been many iterations and many changes, but we're not quite back at the full deduction that we had been before.
Right.
Next slide, please. What was recently passed about a month ago was the infrastructure package. Included in this, there wasn't a lot of tax bills. However, there was one significant change, and that was for the early termination of the ERTC, which is the Employee Retention Tax Credit. The Employee Retention Tax Credit was a refundable tax credit that was utilized by US businesses, similar to what was utilized in the UK furlough scheme to keep people employed and to keep the economy going. This was intended to go through the end of the year, but they cut that off as of October 1st, 2021. Next slide, please.
So I think that kind of goes through what has happened and the bill that have gone through and the changes that have happened with the SALT deduction and the different states. What we're kind of going to focus on now over the next 4 or 5 slides is what is currently at Congress and what is being discussed and the movings around that. So basically, as they've tried to attempt to pass the Build Back Better Act, which has kind of been back and forth, and like I said earlier, I think it's on like the 4th or maybe the 5th iteration. It's been amended multiple times and it's still being discussed. So therefore, it's not actually law, but it gives us a good understanding of what the train of thought is. In terms of timing of when we think it's going to happen, it's anyone's guess. There's different trains of thought. So it's kind of negotiating between the two political parties about who wants what and which senators want kind of things for their specific state members. But we'll kind of go through some of the main high level changes that are being proposed and how they would impact professional services. And some of them will have similarities to what we discussed on the first slide, because some of them are what Biden presented as his presidential package. Some of them have moved and flexed from there. There's some additions to it, so there will be some similarities. So they want to increase the income tax rate. We talked about that previously, so they want to go back to the 39.6 income tax rate. What is new and what wasn't discussed in the presidential campaign was a surcharge on individuals of high earners. So they want to increase or add an additional tax of 5% for people that earn more than $5 million effectively. There are different limits depending on your filing and marital status. And they want to also add an additional 3% for anyone that earns over $12.5 million. Again, the $12.5 million threshold is dependent upon your filing status and your marital status, but that's the lower threshold.
Yeah. And Ashley, sorry to interrupt you, but does that mean that it's 8% basically for people that earn the 12.5 plus?
Yes, so it'll be on income above that. So it'll be
Right.
a top rate up to 5 million, and then from 5 million up to 12.5, it will be the top rate plus 5, and then it'll be 5 plus 8 above that, kind of graduated rates.
Right.
They're looking at changing the foreign tax credit system. So the current foreign tax credit system operates as we call them in baskets. So you basket your income as general business income or employment income. Kind of general income as if you're actively participating in the business or you're employed or something like that. Passive income, so that'd be interest, dividends, royalties, things like that. And then you have like a foreign basket where you have similar things. You'll have kind of foreign general, foreign passive, CFC and things like that, and all that type of income. But what they're doing now, they're changing that. So that was beneficial. So what you could do, you could basket the income, you could look at all of the taxes that you paid during the year. So you'd look at your interest income, your dividend income, and put all them into one basket. You may pay tax at different rates, like in the UK, you pay tax at different rates, but you just basket all that together and you just offset your foreign taxes against that one basket of income. What they're looking at doing now is slightly different, although it's a little bit similar in the sense that it's still going to be baskets, but they're going to do it country by country. So if you have all of your incomes in the UK, you'd put it all into them similar baskets, but for the UK, if you had income that's spread across the globe, which we can see happens in some professional service firms, you'd have to then put that income in different countries and not be able to combine all of them, that income and the foreign taxes. They're looking to, so an excess business loss limitation, looking to limit the amount that you can utilize losses to $500,000 for a joint filer and $250,000 for all other filers. They would be basically disallowed and then carried forward in future years to determine whether you could utilize them with the same limitations. They want to increase the overall long-term capital gains rate. So we talked previously of it being applicable to high income taxpayers. Now they want to, they're talking about increasing the capital gains rate from 20% to 25%. That's not gone down too well. So there's going to be a lot of movement on that. We think a lot of commentary suggests that there'll be movement on that as people kind of lobby their senators to change that. There's going to be a dollar limitation on the qualified business income deduction. I think we've previously discussed this maybe 3 or 4 years ago when Trump made this change. So part of his changes 4 years ago were to reduce tax rates. So they reduced the corporate tax rate was one of the main things. To try and counter that, they included a qualified business income deduction, which was effectively for individuals or for pass-through kind of partnership type businesses. But they're looking to limit that now. And what that deduction was, it kind of worked on how much income they had, how many employees you had, what the salary base was, and then you could calculate a deduction that you could add into your tax computation, which could reduce your income. But they're looking to limit that per taxpayer now. So they're limiting that. The thresholds are relatively high. Again, it's some of the similar numbers to the excess business loss deduction. They are looking to limit that to $500,000 for joint filers, $250,000 for married filing separately, and then $400,000 for other people. Another big change is the net investment income tax, so referred to as NIT on the slide. Net investment income tax was an additional tax that was brought in many years ago by, can't remember which president it was, but it was I think it was about 8 years ago that it was brought in. And it's an income, it's a tax on passive style income, so dividends, interest, royalties, things like that. But they're now looking to expand that to also be taxed on income derived in the ordinary course of a business. And that would apply for people that have income over $500,000 or 250,000 or 400,000 for single filers. So there's a lot of similarities on the thresholds and depending on the filing status of each one. But that would be an additional tax on top of the surcharges as well, which could increase the taxes further. We still don't know how they would all interplay. Hopefully they would kind of interplay with each other and help each other out. So it's not 3.7 plus 5 plus 3 plus 3.8. It could get quite high, but we still don't know. As Megan mentioned on the earlier slide, the current salt cap deduction is at £10,000, but they're looking to increase that to £80,000. Next slide, please.
There's also some current proposals for tax reform on the business side. The most significant one right now is they're looking at the changing the tax rate for corporations. So with TCJA, the corporate tax rate changed and reduced to 21%. It's currently a flat rate. So the proposal is looking at making the flat rate and turning it into a graduated rate like we look at for individuals. So the flat rate is income up to 400,000 at 18%, above that to 5 million at 21%, above 5 million at 26.5, and then after the 10 million base, they're increasing the 3% effectively to change it back to a flat rate of the highest marginal of 26.5%. They're also looking at a minimum tax of 15%, and this is actually going to be based off of book income. So it's an adjusted book income for GAAP purposes with corporations of over $1 billion. So effectively, they're taking a GAAP number and making sure that corporations, for tax purposes, aren't going to generate a loss that they can completely wipe out their tax. There's other things to notice as well as aren't included on here is the R&D credit coming up in 2021 and 2022. The change in R&D credit was required to capitalize 174 expenses. They're looking at pushing that out so that, and which continues a significant benefit, so you don't have to capitalize expenses yet. Also important to note is there's currently not a significant change looking at the sunsetting provisions. So as Ash indicated, the qualified business income deduction could change, but it's still set to sunset in 2025. And in 2025, that would effectively increase the tax rates for members of S corporations and partnerships without that deduction. Next slide, please.
So this is a late kind of removal to what when we prepared the slides. So, but I think I left it in here because I think it's a good slide to understand the train of thought. In the latest iteration of what's been discussed, it's been removed, so it's not included. But basically, what it is, it's akin to kind of the UK's auto enrolment that we had many years ago, and what it is, they want to require people to maintain or facilitate retirement plans, so to try and get people into having pensions. But like I said, it's been kind of removed, so someone's kind of got their way, really. But it's a good idea to have that in mind, that in the future that they're thinking about this, and it may come back onto the table. I think we've seen things that were discussed 3 or 4 years ago that have now come back onto the table and are in these provisions, and this may be one of them. But it was just interesting because it's similar to what we kind of went through in the UK many years ago on auto enrolment.
Yeah, it sort of might set a bit of a direction of travel for what the governments are looking to do over a period of time, but they haven't quite found a way to make it palatable as of yet, so it would seem. But I guess there's always time to put it back in. Yeah,
there's still plenty of time.
Right.
we're hoping that it's soon, that they close everything, but we'll wait and see.
Yeah.
Next slide, please. So we talked previously about some of the international changes as well, and the change to the CFC and GILTI rules. So GILTI stands for Global Intangible Low Taxed Income. And basically, it's a tax on controlled foreign corporations. So if you have a US business that owns a foreign business, a foreign company, and it's controlled, then there's an additional tax that you have to pay. So it's important to notice that there's going to be quite a big change in this. So previously, you would have an effective tax rate of 10.5%. because you have basically had a deduction against that income. But they're going to change that deduction to 28.5%, which would increase the effective tax rate to 15.8%. Another part of the CFC changes 4 years ago were they deleted part of the law. So what that happened with that is it impacted and kind of give a wide more spread of what is a controlled foreign corporation. So previously, where you had a brother and sister company that was owned by a common shareholder, say a US company or a US person, they wouldn't be seen, the CFC wouldn't be seen as, the foreign company wouldn't be seen as a controlled foreign corporation because it's owned by a UK company, for example. It wouldn't generally be a CFC. But now what it looks like is if you've got a US company within the structure and it's a brother-sister relationship, effectively, it kind of, for US tax purposes, it changes the structure and it puts the UK business underneath the US business and says it's a controlled foreign corporation in very simple terms. Now, there's been notices and revenue rulings from the IRS to try and mitigate the impacts of that. But they are looking to basically just rewrite the exact same law that we had 4 years ago, so then we're not impacted by it. So hopefully that comes in, because it's been a pain trying to get through how that impacts people and what it works, particularly when you've got a foreign-owned, controlled foreign corporation where there's a lot of reporting, but there's actually no tax at stake, so there's no value that that we're adding. It's been really difficult kind of discussions to see what the value add is if it's just reporting. One very important thing that's currently going through or being discussed is the portfolio interest exemption. So when you debt finance a US company, there's potentially withholding tax. So one of the exemptions, the domestic exemption, is that there's no withholding tax on portfolio interest. So there's various conditions to go out and be met, and one of them is that you cannot own more than 10% of the voting stock of that US company. The ownership requirements now looking to be extended to both vote and value, because of some perceived structuring where people have structured that votes are by someone else and value is actually owed to investors or to other people. So now they're looking at bringing in vote and value. So that will have some impact.
Yeah, and actually, look, some of the things that you both talked about will make quite a big difference to people, you know, in terms of planning and things like that. So I know these are all current proposals, but as you've sort of said all the way throughout, that things are being put in, things are being taken out. And what's the feeling? Is there any indication about which ones will actually stick in the end and which ones will actually no longer be there? You've already talked about the sort of similar contribution to pensions effectively that we've got in the UK that's just been removed. So have you got a view?
So I think the feeling is, and my view is, and I think we probably all know this, everyone needs revenue. So everyone's looking to raise revenue. So I think the increase in the tax rates is definitely ones that are going to stay, but which ones are they going to pick? Are they going to remain with the income tax, or are they going to increase the corporation tax, or increase both? There's definitely likely to be a movement on the corporation tax side. I think both sides of the house kind of want that. Whether it'll go up to the pre-Trump 35% is probably unlikely. That's just not the way of the world. I think everyone kind of agrees that the 39.6 is generally okay on income tax because they're kind of used to it. So we'll kind of wait and see. It'll probably be somewhere in the middle on the corporation tax, but I wouldn't be surprised if income tax goes up to the 39.6. The surcharges, we'll see how they go through and what happens with them, because they are brand new. It might take a bit of pushing, a bit of persuasion with that. It's definitely interesting times, and there's lots of things that have come up since the pandemic as well. So a lot of sensible, but also some quite strange and wacky ideas have been floated about. I think this is the end of kind of the US tax part updates. So I think Louis is going to take us through US basis reform and how that might impact UK US businesses. Next slide, please.
Thanks, Ash. So I just wanted to spend a few minutes on the basis period reform in the UK. We've been spending a considerable amount of time over the past few months looking at this and considering the implications that it might have over here. And I think, of course, dealing with US firms structured as partnerships and have branches or operations in the UK, this is definitely going to have an impact for them. And it's just raising awareness to making sure that this has been considered, I think. As a little reminder, a basis period is effectively the time period for which a sole trader or partnership pays tax each year. So usually the business's basis period will be the same as its accounting year that ends in the UK tax year. So as we know, for US partnerships with operations in the UK, this is going to be the calendar year, so 31st of December. So the UK's announced a basis period reform. Effectively, it's proposed to assist making the transition to making tax digital simpler. It's also thought that it's going to simplify the tax administration for partnerships, although I think there's been some lobbying that this might not necessarily be the case. And also in the year of transition, which we'll come on to, it may also lead to an acceleration of the taxes in the UK potentially. So this is happening relatively soon. The transitional period for the new basis period rules will be for the tax year ended 5th of April 2024. Previously, before consultation, it was supposed to be coming in for the tax, or the transition year was supposed to be for the 5th of April 2023. However, that wouldn't give enough time for advisors and businesses to get all their systems aligned and ready, I don't think. And then the new system is going to take full effect for the tax year ended 5th of April 2025. So next slide, please. So what exactly is changing? There's a move away from the current tier basis of taxation in the UK. As mentioned before, that's effectively the accounting year ending in the tax year. Obviously, we've got 5th of April tax year in the UK, so that would most often be 31st of December for US firms. It's widely recognised that this method of taxation created complexities. Overlap profits and opening year rules were considered complex, and it often led to difficulties when looking internationally and how that matched with foreign tax credits and reporting overseas. So the new basis is the tax year basis, so effectively to 31st of March each year, which is taxing of profits accruing in the tax year. And that may require estimates for accounting years which aren't completed when returns are due, hence significant administrative burdens for firms, hence a bigger lead time for putting in the transitional year. So lots of potential issues and potential additional advisor time spent assisting firms in managing the changes. If we move on to the next slide, please. So in order to try and really visualize what the changes are, we've set out an example of a partnership with a 31st of December year end and the impact of the change in the rules. So XYZ LLP, 40 members, and draws up accounts to 31st of December. The 12 months to 31st of December in this example, 2023, his profits are 20 million. So under the current rules, assessing all members on the current year basis, the members' basis period would be for the 12 months to 31st of December 2023, and members would be taxed on their share of the 20 million profit. So under the transitional rules in the year of change, which is the tax year ended 5th of April 2023, the members would be taxable on their share of profits for the 12 months to 31st of December 2023, but they would also be taxable on 3/12 of the profits to 31st of December 2024. Albeit that overlap profits, being the amounts taxed twice on creation, would be relievable in the transition year. But as we know, for partners who became partners several years ago, that offset is likely to be lower than the additional profits generated in the year. So this brings profits into line with the tax year basis, but results in 15 months of profits being taxed in the transitional year, as I mentioned, albeit with the overlap relief being utilised. Next slide, please. So based on the figures in our example and using quite high estimated profits for the 31st of December 2024 profits, this could effectively lead to, in some circumstances, significant additional liabilities. And as we've noted on this slide, this could be an additional tax liability of 175,000 per partner. due in the transition year under the new rules. There is an automatic spreading relief for the additional profits to be spread over 5 tax years to help mitigate the additional liability, and it should be noted that this is additional profits and not the tax. So you can't lock in the tax for the additional 5 years. It would be the additional profits over the additional 5 years. So if taxes were to rise in future years, for example, and you've got your spreading over 5 years, you'd be subject to the higher rate of tax in that year that the additional profits are recognised if you spread over the 5 years. You can elect out of this automatic spreading and pay the additional tax in one hit if the preference is there, just to effectively get this done in an earlier year. So many of the firms that we are speaking to are currently running the calculations to understand what additional liabilities might become due. Obviously, for US headquartered firms at the 31st of December year end, you've got that 15 months of profit in the year of transition, less overlap. For UK firms who are, for example, structured as 30th of April year end, it could be as much as 23 months of profits in the year of transition, less overlap. So a much bigger impact is on firms of 30th of April year end, but still, of course, needs to be borne in mind for firms of 31st of December and what this looks like for a cash flow perspective. And then, as mentioned before, going forward, effectively taxed on the tax year basis, so that'd be for the 12 months to 31st of March 2025 and the 12 months to 31st of March for each of the following years. So they're effectively taxing the profits accruing in the tax year, and estimates might be required for accounting years not completed when returns are due. Next slide, please. So the consultation for the change in the rules took place this summer. BDO were amongst a number of firms responding, which helped provide positive developments in a number of areas compared to what was initially suggested in the change of rules. This included a delay in the timing of implementation for the transition period by a year. Also, the excess transitional profits will not impact certain allowances, such as pension allowances and means tested benefits, which is quite a big point. Any loss due to excess overlap can be carried back to the previous 3 years instead of 1, given the acceleration of time that individuals would generally use will crystallize their overlap profits. Certain firms, not necessarily US based, may want to consider change their accounting date to the 31st of March to be in line with the tax year basis, and it's now been clarified that you can do this in the transitional year without losing the benefit of the spreading relief. But as mentioned before, that's not likely to be important or relevant for US headquartered firms. Next slide, please. So what are the key considerations for businesses to think about? As mentioned before, model the cash flow impact in the transitional year to understand additional liabilities. There is spreading available, but you still might want to understand this for cash flow purposes. Change your accounting year end to 31st of March. Again, not relevant for US headquartered law firms, but for other firms, it might be something to think about, but obviously you want to kind of also consider aligning to international filings, and often firms may want to keep 31st of December for simplicity. The effect of the funding requirements with banks, given the change in the cash flow. Firms often have their cash flow forecasting for the next 5 years, so we've been in discussions with various banking funders and facilities to see if they'd be willing to help firms out in potential acceleration of taxes and changing their cash flow forecast models. There's been various discussions around this, potential increase in interest rates on lending to consider. Other firms are looking for other investors to help in such situations. So lots to think about on that position. Communication to partners, making the message as simple and as clear as possible for the individual partners to understand the position. Some partners in a firm may wish to utilize spreading, whereas others may not. So it's effectively trying to model that all as a firm, and if there'll be a firm policy on this is an interesting discussion to have. The impact of double tax relief in the transitional period going forward, and also considering the credit in the US for the UK taxes paid, because obviously we're moving in the transition period, the period that we're assessing, and often obviously we advise firms to pay their taxes before the 31st of December for credit purposes in the US. Spend a bit of time assessing the utilisation of the overlap profits, as we've talked around, to make sure people are getting, where possible, maximum relief on crystallisation of overlap profits, and if not, looking how to carry those back, as I said before, with the increased potential 3 years instead of 1 year. How this change impacts any secondary partnerships, so for partners with multiple interests, where their overlap profits lie, and what their income sourcing is looking like in that, to make sure they can maximise relief, or also to look at the impact of the accelerated tax. And finally, how your internal systems are going to need to be adapted, your finance systems, to manage these changes to reporting, and again leading back to cash flow forecasting as well. So I think quite a lot to think about, and obviously for those US firms who have operations in the UK, we have a structured partnerships generally, this will have an impact on their taxation position. Over to you, Anna.
Yeah, thanks, Louis. I mean, I think, just hearing how many changes are happening in every jurisdiction. I know we're just talking about UK and US here, and mainly focus on the US, but other countries are going through this sort of review process and making changes, as Ashley said, in terms of looking for a tax take. And this interaction between all of the taxes and the jurisdictions is fascinating. You've got your advisor really needs to be thinking about how everything interacts. And Louis, we talked there about sort of the firm policy on perhaps basis period changes, and whether the sort of the transitional period needs to be extended over 5 years, so that you're really just sort of reducing the impact on cash flow. But that could have an individual effect on specific people who might not want to elect, or they might want to elect out of the spreading rules. So depending on, Ashley was talking about the changes in the baskets to do with double tax relief and things. So fascinating, but also worthwhile thinking through all of the real detail on this, rather than just keeping it at a high level. What's the firm going to do? How does it affect actually individuals? Right, so now we move to Q&A. So thank you for our 3 speakers so far. So some questions. So I think this one is either to Ashley or Megan. We're really close to the holiday season, and of course in the UK we've been talking about more plan Bs and working from home and things. What's the possibility that anything will change before the new year when it comes to US taxes and the reforms that you've been talking about?
I would say it's anyone's guess, really. It's difficult to say. We saw 4 years ago that the Trump changes were signed in late November, so they were very close to the wire as well. I've seen recent commentary from colleagues that are quite close to, that work in the Washington office and are quite close to the lawmakers, that we don't know we don't know the date, so they're still negotiating and jostling for their own agendas. So we really don't know. It's commentary that it could be before Christmas, because they're trying to focus their mind to get it done before Christmas, or it could trip into the new year. I think the later it goes into the new year, the less likely that some of the tax changes will come. That's the general thought, but who knows? Yeah, okay. And sort of a linked theme, I guess, because these changes often create the demand from our advisory services. So what are you currently working on? What's the volume, the thing that you were going to point to that people are taking the most advice on at the moment? So me personally, I've worked with quite a lot of businesses in the UK that are looking to enter the US marketplace. I think even with all the changes that are being discussed and the possible tax rate increases, people are not being deterred by that. Particular business in the UK that want to expand and drive value in their business are still looking to expand into the US. So that's not really gone down. I've actually seen quite a lot of that this year, including consultants, technology firms, logistical firms. There's been kind of a mini boom, I would say, that we've worked on that. I spent a lot of time with them based on how they're going to deliver their product or their service in the US, looking at kind of, are they going to have people on the ground, Are they going to deliver the product remotely from the UK? Is there going to be a mix of it? And then considering things like permanent establishment and also state considerations. State considerations actually has been quite topical as states have moved onto more of an economic nexus basis. So really looking at where the customer is, opposed to looking at where you have an office or where you do business. There's a lot of states that have changed from that now. So they previously had kind of a 3-factor. They'd look at your revenue, where your revenue is driven from, where your employees are, and where you have property. They're now just looking at where your revenue is. That's what a lot of the states are moving to. So they're the main things that we've been working on.
Yeah, and of course the pandemic has meant that lots of people are moving around, and there's lots of opportunity for professional services to advise other businesses. So hence the mini boom, I think, that's sort of being seen across professional services in many sort of the people like law firms and property advisory firms, etc. So a common theme, I think. You talked about basket. I'm sorry, there's a few things aimed at you, Ashley, but Megan can sort of chip in if she'd like. You're talking about the basketing, the changes for the double tax relief and the baskets. Do you think the changes might create sort of more issues with getting relief for double tax relief, or is it just a sort of a mix up of administration rather than a sort of impact in the tax take?
I think it can impact the tax take. So if we compare the tax rates in the UK versus the US, so you look at, let's say, interest. So interest in the US will be taxed at the 39 points or 37% currently, potentially 39.6 at the top rate. In the UK, it'd be 45%. So there's a tax differential there. If you have tax-free jurisdiction income, so if you have interest from, I don't know, a jurisdiction that doesn't, pay tax, you would basket that income from the UK and income from the non-taxing jurisdiction into one basket as passive, and you could use your UK tax credit against that total income, which may or may not offset the total tax on the overall income depending on the numbers. But in the proposed system would split them, and you'd have the UK would all be covered, but you'd have a carryover of foreign taxes. You'd have paid more UK tax than the US tax suffered. But on the non-taxing jurisdiction, you wouldn't have any foreign taxes, so you would generally pay US tax. So I think it is going to create more tax potentially.
Yeah, an interesting one to be modelling out, I think, if that does come in quite quickly, to work out sort of the impact on what's going on. Lots of professional services firms obviously share their income and sort of try and balance out if there's some sort of level of equalisation. So understanding what people are facing will be a useful exercise, and also might drive some of the commercials as well as, just understanding the tax position. I think this one's for Megan. This one's about the R&D tax credits. And so I just wondered whether there was a piece around incentivising people to invest in these areas, and whether you had a particular view on that.
Definitely. I think the R&D credit was set to sunset so many times. It originally came in as, I can't even tell you how many years ago. So luckily the TCJA made it permanent. However, there was that issue of capitalizing the 174 expenses. So with the capitalization of 174 expenses, you no longer get an immediate deduction, which would then, especially in an economy that we're looking at right now, limit the potential of people wanting to go and invest in those R&D dollars if they know that it's not going to provide them a deduction, and they're going to be stepping into an increased potential tax rate. So I do believe that keeping the R&D deduction available and not having it currently sunset would facilitate the push of businesses to continue to invest in R&D.
Yeah, and as you say, if there's quite a lot of flux in terms of the tax systems, and if there's a belief that this is a high rate time because of the pandemic, but that might peter off, then there are real commercial decisions that need to be made about where people put their dollars at any one time, whether they defer it because of the uncertainty or whether they put it in and invest now. But I mean, the sort of the experience that I have and my colleagues are having is that professional services firms are doing very well at the moment, and so therefore hopefully that means that they're investing in these sorts of things and sort of exploring what they can innovate into. Good. Okay. Well, thank you. I've asked the speakers if there's any final comments. Otherwise, I will bring the discussion to a close. No?
No, there are no final comments from me. I think it's just a lot of it is a watch this space, and some of it will kind of come to fruition at some point. Hoping soon.
Yeah. No, it certainly seems like it's even more important that all of the advisors stay joined up. So, you know, thinking about everything as a collective rather than individual silos. You know, there's so much change going on that will impact each other in terms of the overall tax take. So thank you very much, Ash, Megan and Louis. Very useful, really appreciate it. So we will close the webinar there. We'll circulate the slides and the recording in due course. And if anyone wants to see any of the historic sessions that we've run, Ash has been a feature in many of those over the years. We can sort of look back and see how young he looked back then when he first started to live. So thank you all, and we'll see you the next time. Thank you.
Thank you.
Thank you.